I didn't really grow up with any direction. My was very successful and then unfortunately lost his businesses. I thought, well, what am I going to do with no money? Oh, I can make money with other people's money. Within a year, I was running a hedge fund. Anybody who has an opportunity to get a foot into a door, that's oftentimes luck. It's what you do when you get in that door. That's the work, and that's where you end up, and how far you go is up to you. When you have limited capital, we all have limited capital. It's about where you're going to apply that capital. I'm going to find out where my capital is going to work best for me. I make more money now, not trading the way I did, but I don't watch the market every day. You're not going to get rich off the dividends. That's tip money, really. You're going to be right most of the time if your thinking is clear. That's it. Just trust yourself. You should never worry about what you missed. Never. Dumb it down to a narrative. I trade very successfully, invest very successfully, and have for years on narratives. Investing is easy. It's not hard. This isn't brain surgery. I'm just putting some money into an idea that I believe in. Everybody wants to get rich in the capital markets, trading, investing, and you can. You just have to manage your losses.
Investors, welcome back to another go-round of Masters of the Market. Now, this week, I cannot be more thrilled to have on with me Shah Gilani. He is a former hedge fund manager, but not only that, a current chief investment strategist over at Manward Press, and just an absolute powerhouse within the financial industry. So Shah, welcome to Masters of the Market. And I want to go ahead and just throw the first question over to you and ask you about your story and how exactly you got to where you are today.
Well, Ari, thank you very much for having me. It's a delight to be with you. My story really started, I would say, almost serendipitously. I went to school at UCLA and studied economics. My path wasn't to finish. I was hoping I would finish and get a master's degree, but needed to work and take care of the family, so to speak. And so I ended up got a job opportunity in New York. I was supposed to start on a Monday, and I left California on Friday, and big job opportunity trading over the counter as a junior associate, starting trading over the counter, working for a bigwig in New York who I had the good fortune of meeting and who liked me and said, I don't care if you finish school or not, I want you to come and work for me. So I said, okay, great, I'm on my way. And Friday, I have dinner with another bigwig through someone else I knew who offered me a job in Chicago. And I said, New York is the epicenter of finance. Why would I want to be in Chicago? He said, Shah, that's where the gunslingers are, because that's where the derivatives markets were. That's where the options markets were. The Merc was introducing all kinds of futures contracts on currencies, and everything was really happening there in Chicago. And I took that job opportunity. That turned into running a hedge fund. Within a year, I was running a hedge fund. So it was a very steep learning curve, but that's what I did, and I really enjoyed it. But being immersed in trading on the floor of the Chicago Board of Options Exchange was a tremendous learning opportunity, and I grabbed it with both hands. So that's where I started, on the floor of the CBOE. I started out as a clerk, and a year later I was general partner running a pretty sizable hedge fund for the early 80s, 1982. And that's really where I took off, and that's where I learned everything and grew from there and had a very interesting trajectory there. From there I ended up running the futures and options division for Lloyds Bank, one of Britain's largest banks, running all the hedging for the Treasury, where all of the bank's money and the depositors' money is traded and the forwards are done. And so I ran hedging for the government bond trading desk, for the currency desk, and for the OTC derivatives desk. So that was a tremendous experience there. And then went on, ran a couple of boutique firms in New York running their trading desk, and then started a hedge fund. And another one, I was like, okay, I did that. Then I had this giant opportunity to work at a bank, which, by the way, is not all as cracked up to be. Banks, wow, I learned a lot about big banks and how they operate. Sometimes it's pretty scary. Anyway, ended up then saying, okay, I want to be more independent, do my own thing. So started another hedge fund and had a good run with that. That's pretty much my trajectory in a couple of sentences, a little more than that. But yeah, so love what I do, love trading. Trading to me is fun. I'm glad that I'm not running the hedge fund anymore, because that's 24/7. Decided I just need to slow down and enjoy my life a little more, because the markets are 24/7. There's always something trading somewhere. When you're running a macro fund, I traded everything across the globe. Kind of happy that has cooled down, and running Man Press is terrific because I have the freedom to do whatever I want to do there, to recommend for my subscribers what is the best opportunities. So I run that with services the same way I ran my hedge fund. We're pretty much macro. We look for opportunities wherever they are, and they are everywhere. So we have a lot of fun doing that, and we trade and invest and do a lot of fun things.
Joe, did you always know you were going to kind of go down this trajectory and be where you are? Or was that, was a pipe dream for you almost as a young kid?
No, it wasn't really. It was something that happened because I needed to make money. I needed to find a career. I didn't really grow up with any direction. My dad didn't really give me any direction. Was very successful, and then unfortunately lost his businesses. And then I didn't have any direction. So it's not as if I had I'm going to grow into my father's business, I'm going to run that, or my father groomed me to do this, learn that. It wasn't like that for me. And so I had to figure out, what am I going to do? And the short answer is, I didn't know. So I thought, well, what am I going to do with no money? Oh, I can make money with other people's money. And how do I do that? And I was probably 14, 15, when I'm trying to think, what am I going to do with my life? Oh, I had met someone who was a stockbroker. A gal from school's dad was a stockbroker. And I said, well, he dresses well. He has a nice home. I'll be a stockbroker. I didn't even know what that was. So I always thought, okay, I can do that and make money with other people's money and learn how to invest it for them and make money doing that. That's sort of that was the kernel that I started with. Then I learned I don't want to be a stockbroker. And I didn't really, because I didn't have the schooling really to be an investment banker. Trading was just I stepped into it and loved it. And that's, again, when I said serendipitously, that's how it happened. It wasn't something like, oh my gosh, I want to be a hedge fund manager. That's my goal in life. It was no, but it ended up fine. So it was all
more
good.
than fine, I would say.
More than fine. Yes, I'm very fortunate.
I want to ask, how much do you think luck played a role in your earlier career? Because we have a lot of young investors who are on here, or young viewers who are watching. Maybe they want to get into finance. Does luck actually play a role here?
For me, luck plays a role and did play a role in terms of being introduced to people that opened doors for me. Anybody who has an opportunity to get a foot into a door, that's oftentimes luck. It's what you do when you get in that door. That's the work, and that's where you end up, and how far you go is up to you. But I think luck plays a big part in terms of opportunities. It has for me. When I started on the floor basically as a clerk, I didn't know anything. And I had to learn, and I really worked hard at it, read everything I could. And that was a lot of hard work, but it paid off. So once you get in the door, if there's luck involved in getting in the door, then just be thankful, because luck's a beautiful thing.
Now, you mentioned there are opportunities everywhere, and especially when you were running the hedge fund. I mean, you were up 24/7 looking for those opportunities. This begs the question, what exactly is the best starting point for an investor? And I'll give you two avatars. One investor is, say, in their early 20s, and the other investor is perhaps a little later in their game and in their, we'll say, mid 30s, 40s, just getting started investing.
For both of them, it's really the same starting point. And I say this often, I have this discussion with folks now. Well, how did you start, or how do I start? I say, you just start, and you don't overthink what you're doing, but you put on a trade, and that's how you start. It's not an investment. If people are, I think, afraid to invest because they don't know what to do. But I always say every investment starts with a trade. You're putting on a position. If it turns out to be a great position, you bought Microsoft years ago at $25, or you bought Apple at 25 cents, maybe didn't think it was going to be an investment, but because if you did, you would never buy it. You would, I don't know, you could do all the math, and you look at the metrics, and you look maybe the balance sheet of this and that, and you overanalyze, and then it's like, I don't know, because that didn't work out, or that didn't work out, or well, what if I invested in that and that went down? It's not that complicated. It's, you put on a trade, you put on a position. If you're right and lucky, that ends up being an investment. And maybe you have a lot of investments that end up being worth millions of dollars. The starting point is always the same. You have to have some conviction. You don't have to, you're never going to know, but you have to have some conviction about the position you're going to put on, that it's going to do this, it's going to do that. And if you have a pretty good understanding of why it's going to do this or that, or you expect it to do this or that, you buy the stock, whatever it is that you're going to buy, whether it's a commodity in ETF form, which now makes, ETFs make life so easy. When I was doing all the trading, when I needed to go to do something in currencies, I was trading forwards or futures. I was doing derivatives. Now you can pretty much trade what you want in ETF form. You know, on an exchange traded basis, it's fantastic. You can put stops in there, not and go to sleep and not worry about it. It's traders have a different and an easier path now to do what they want to do. But to do it, you have to start. And that just means putting on a position. Not all of them are going to work out. Don't worry about that. That's part of the learning process. On the floor, when I started on the floor, everyone said, you know, you don't want to start off, you know, making money, every trade, making money, because then you think that that's how it works. And then when you get devastated by a bad trade, because you think you know everything, then you don't know. So it's better to have losses, because then you learn from those losses, but you have to minimize losses, obviously. So you narrow those down to, you know, 5, 10, 15%. It's like, it's not going to impact your capital. It's like, I can live with that. And then you learn from that. Anybody starting out, especially, I think there's a problem in the United States, probably the world. Young kids are not taught how to invest. They're not taught about the capital markets, how to use them. You can be a street sweeper, a laborer, and you're never going to get rich. But if you take your wages and you apply them in the capital markets, you will become rich. Kids aren't taught that. It's like, okay, you know, I make an hourly wage. How am I ever going to be able to retire? You can just start. And I think young people, the younger they start, the more they learn, the faster they learn it, the richer they're going to become, because it's not a difficult game. It is a game. Trading, investing is a game. You just have to, it's like the lottery. It's like that saying, you got to be in it to win it.
Now, fear plays a huge role, obviously, today, more now than ever. It's as easy as can be to get started in investing. To your point, I mean, there's ETFs, stops, right? There's anything you could possibly think of right now in today's day and age for an investor. But yet the masses, I feel, still are afraid to get invested. How do we overcome fear?
It's a great question. I think the only way to overcome fear is to attack it, and that is to put on a trade. And the fear that everybody has is, I'm going to lose money. That's the fear. And yes, you are going to lose money. If you recognize that from the get-go, yes, that's part of what I'm doing here. It's not a one-way street. It's a two-way street. I just have to be smart about when I do have a bad trade, what am I going to do about it? You have to have a plan. It's like you just don't sit there like a deer in the headlights and watch your capital disappear because the trade goes against you and you put too much into it. It's like, oh, there goes my savings. It's going to happen. It's just have to manage your losses. Fear is something that can be overcome very easily, and it's overcome when you make a couple of good trades. And you realize, wait a second, this isn't brain surgery. I'm just putting some money into an idea that I believe in. And I think this company executes that. I love their product. I use their product. That's what I do with them. Oh, I know what they do. I know how they make their money. Oh my gosh, this is a brilliant company. I want to own a piece of that. And I think the stock is going to go higher. Okay, that's it. That's how you start. If you're wrong, you're wrong. By the way, you may be wrong simply because the market goes against you. You might be right about the stock you picked, but if the market is going through some downturn or correction, generally speaking, your stock will probably go down with the weight of the market. Doesn't mean you didn't have, your conviction wasn't correct and you didn't pick a good stock, but that's when you have to decide going in, okay, what if this goes down? What am I going to do? And you haven't lost money until you sell it at a loss. So if you hold on to it, it's a really good company. It's like, that's okay. It's going to happen. Oh, maybe you turn your fear into a positive. It's like, oh, it went down lower. I like this at $15. I'm going to buy some more at $12. I'm going to buy some more at 10 because the market always goes up. So eventually you're right. Like, wait a second, I averaged down and now it's at 40. Great. So I think fear is just fear is opportunity in my book. If you take your fear, turn it into opportunity. Just be smart about it's really about managing your losses. Everybody wants to get rich in the capital markets, trading, investing, and you can. You just have to manage your losses.
I always say everybody's trying to get rich by Tuesday, and sometimes it just takes a little bit longer than that.
And those are the folks that throw the dice and then they're like, "Oh, that's I lost all my money." Well, you shouldn't have thrown the dice. You might have play the longer game.
Shah, I want to ask you this. I mean, you're a man of Wall Street. When it comes to trusting Wall Street, like trusting the analyst, because some people have the fear and they go, you know what? I'm going to overcome the fear, but I'm going to put all my trust into an advisor. I'm going to put all my trust into the analysts. Is Wall Street really to be trusted, or should we almost take the street to ourselves, do our own research, and do our own investing?
Another great question. I don't generally trust Wall Street analysts because, for the most part, they work for a bank, for a brokerage or company, and their job is to sell. That's what they're doing. They're selling, and they're selling their research in terms of, okay, trust me, I analyze these companies and they're a buy, right? They end up with a buy recommendation most of the time. And if you look at a lot of the analyst recommendations, most of them are buys. Very few of them have a sell. Very, very few. Why? Because they don't get paid to have sell recommendations. Because the bank's customers, the brokerage's customers, the clients, they want to know where to put their money, and they want the analyst to have conviction. So if the analyst says sell, it's like, well, wait a second. So you got me into this. Now you're telling me to sell it. So why did you get me in the first place? So you very rarely see analysts say sell. They'll change it to a hold, from a buy to a hold, or from an outperform to a perform. So I don't trust them. I listen to a lot. There are a handful of people that I listen to because they're big thinkers. And that's what individuals have to do, is think big, because it's not about the nuance. It's not about the small metrics. It's not about breaking down through looking through every aspect of a balance sheet to figure out, is this a good investment? It's really about the big picture. So folks that talk about the big picture, that's what I want to hear. I want their opinion about that. And I'm going to make my own opinion, but I'll take all of their thinking and condense it into, what do I think? Because I'm the one making the decisions with my money. And for my subscribers, I make the decision. So I just want to see the whole field and make my determination on what to buy or what to sell or what's going on. But the big picture is the most important thing. And that's, what's the market doing? Are we going up? Are we going down? Is this a correction? Everything plays from that. You don't want to be in the wrong side of the market. You don't want to be buying things and going long on in a down market. Just wait. Unless you want to short stuff, you want to buy put options or put spreads or do something like that, or buy inverse ETFs, fine. You can play the market going down, and we do. I'm very successful trading the markets both directions. But for those investors who are starting out who don't know how to do that, when there's nothing to do nothing. Step out and just wait till you see a positive market and say, okay, now I'm going to apply some capital here because I think the market's going back up. This dip is over. And oftentimes I love to buy dips, but investors, that's a scary moment. The market's going down. It's going down. I'm glad I'm not in it. Me, I'm looking for that. I want them to go down because I'm going to buy more when they go down, because they always go back up.
Well, let's talk about how to find the real golden egg there from the goose. How do we go about picking a stock? Like, how do we actually go about this process? Let's say we overcome the fear. Let's say we chuck Wall Street aside and we start to do some of our own due diligence, and we're there. We're at the firing lines.
Really, not dumb it down, but take this whole process that looks so difficult and deep and a high hurdle to get over, and dumb it down to a narrative. I trade very successfully, invest very successfully, and have for years on narratives. Now, what is going on? And there's stories, and investors apply capital, money, based on a psychology of like fear or greed. And that's based on the narrative, the story that they hear about a stock. Oh my gosh, the CEO is leaving, time to sell that, or whatever it might be. Oh my gosh, they have a new product. Oh, their AI is going to be better than anybody else's. They're going to have the next greatest product because of their AI. Oh, okay. if you look for those narratives and understand what they are, and then see how the company is going to work that narrative, that's a simple starting point, and that's probably the easiest and best, because we all understand the story. Just have to understand the story that you're hearing, the narrative that's before you. Understand exactly what it is. Because a lot of the stories, there are sub-narratives and there are different pieces to the narrative, but you don't just take, the first idea that you have that someone gives you and say, oh, I understand. No, understand really what the narrative is. And when you do understand it, then you can invest appropriately. It's really the big picture stuff. I used to just go through all kinds of metrics on trades and investments. For many, many years now, I don't do that. I'm much more successful looking at the big picture, trading the narratives, understanding what this company does, why the addressable market is going to be bigger and bigger and bigger. And well, that's going to mean more revenues. That's going to mean more profits. And just understand that. I don't need to go into the depths of their balance sheet to look at levered free cash flow and things like that. I do, but that's after the fact, after I've found a narrative that I think, that makes sense. That's going to be successful. That's a good company. I want to invest in that. That's how I think everyone should look at it, simply because for starters, folks aren't going to get into the weeds. Don't know how to. And that's where the fear comes. It's like, I don't know how to do this. Well, you know how to understand a story. That's it. Follow the story. And if you understand the real story, and if there's a story behind the story, then you'll be ever more successful. Because if you find the real story, and that's the narrative you chase and you invest in, you're going to be right 95+% of the time, and you're going to make money. So I like to keep things simple, and this is what I do with my own trading, my own investing. And I'm very rarely wrong, because if you understand the narrative, other people understand that too. And they're investing in that also, on the same theme, for the same reason, same direction. So you have the support of the narrative, bringing in other investors, other traders to buy whatever it is that you think is going to go up. That's not that difficult to figure out.
What is difficult, I feel like, to figure out is when the narrative changes on you, or perhaps it's not changing, but only in the short term it's changing. So you have to go through this monotony of, okay, do I sell? Do I hold? Right. And what's that approach like for you? What do you do when the narrative changes?
You change with it. But you have to understand what the narrative is, and if it's really changing or what's changed it. And we have a perfect example. What just happened in the market, the dust up we just had, where all of a sudden the big mega tech stocks, the leadership group, the Magnificent Seven, started rolling over. They made their highs in July, and they started rolling over. And the narrative on the financial press and everywhere I looked was, oh, this AI thing is maybe a bubble, and maybe these companies have overspent, and it's going to take years for them to monetize their investment in AI. And that was the prevailing narrative, like, oh, everyone's overspent. And so it looked like indeed the leadership stocks were going down. So the Magnificent Seven were going down. Everyone's like, oh my gosh, they're paying attention to what the media was saying about this and that. I didn't see that. I was like, well, that's what they're saying. That's the narrative, but we have to look behind it. Is that what I think is happening? So no, I don't see that, because these big leadership companies, they have the cash. I mean, they have tens and tens of billions, in some cases, 50, 70 billion dollars in cash, and they're constantly generating cash. So for them to spend $30 billion over the next 2 years on AI is nothing. That's what they need to do. So why are the stocks going down? That doesn't make sense. They're investing in the future, and we know that AI is the future. So that doesn't make sense. That narrative didn't hold water for me. And the stocks were coming down. I said, what's really driving them? And then I came to understand, oh my gosh, this yen carry trade, that now we understand that was the yen carry trade. And I can now put it in front of your listeners, your viewers, by telling you what actually happened and how that narrative, nobody really understood. But what all it was a massive trade, technically probably up to $4 trillion trade globally, where big investors, institutions, hedge funds, giant traders were basically borrowing. They were selling yen because they could. They were selling yen to buy dollars, for example. And because the yen was flat and going down, that the cost of that trade was a positive carry. So they take then the dollars that they're basically financing with a depreciating yen, and they're buying the Magnificent Seven because that's where the money was. Those stocks were soaring. So they levered themselves up. When the yen started to rise, and the Bank of Japan was talking a couple months ago about maybe raising rates, that was going to increase the value of the yen against the dollar, and that trade was going to start to unwind. What happened was they raised rates. The market, smart players, big guys really got that, and they started selling. So what we saw was that selling was not really that narrative that, oh, these big companies have overspent on AI, that it's going to take years to monetize it. No, that was a trade unwinding. And if you knew that, and you made, and the AI narrative story of overspending was nonsense, then you realize, and I did, it's like, oh my gosh, this trade is unwinding. That's who's selling, because they levered that trade up unbelievably so. It's a $4 trillion trade across the globe. That's what knocked those stocks down. So that's where understanding the narrative there was, okay, if that trade continues to unwind, the market's going to continue to go down. But what happened was the Bank of Japan said, "Uh-oh, we didn't know we were going to cause a global meltdown. We're not going to raise rates anymore." And then the yen settled down, and then the market just bounced back up. So it had nothing to do with that narrative that people did follow. So that's what I mean. But you have to understand the narrative. There are all kinds of narratives out there, and if you have to just sort of keep your eyes wide open across the whole field to understand what's really going on. And that was a buy the dip opportunity, because when that trade settled out, and it's still being unwound, but now it can be unwound, at a more leisurely pace for those big traders, the market just bounced back up. So that's about narratives. That's about understanding the story behind the story and what moves the markets. If anybody got that big picture, then that was a monumental buy the dip opportunity for the mega cap tech stocks. And that's how I like to trade. I like to look at things in the big picture, because you're not going to understand that if you're looking at the balance sheet, if you're looking at the sales and the earnings per share and no, you're going to understand that big picture, and that's where you make your moves.
Shah, guaranteed some people may be watching this and say, Shah's got connections on Wall Street, the big players, and he's easily able to understand this big narrative because of the connections. Is that the case? And if that's not the case, then how do us, I don't want to say little guys, but guys that aren't on Wall Street or guys that have never been on Wall Street, how do we actually come in to really read up on the narrative?
It's got nothing to do with connections. Nothing. I do know a lot of people. I never discuss my positions or ask any of my hedge fund friends or anybody, what they're doing or what do you think of this. I make my own decisions based on the narratives that I see and read. So we all have that understanding of what's going on in the world. Just apply that. It's sort of that blink thing that we have it. Every investor, every wannabe investor or trader watching us, listening to you, has it. They just have to trust that they have it. There is no magic. There is no, it's all about the connections and, oh, I'm on a line to so-and-so, they're buying, so I'm going to buy. What do you say? What do you sell? It's not, when you're on a trading desk, yes, there's a lot of that going on at that institutional level, but that's about collecting information. It's about understand, well, who's doing what? He's a big player and he's going to be selling his position, but that's not going to affect you over 6 months. It might affect you the next couple of days when someone's unwinding 40 million shares or something. It's like, oh, that's why it's going down. When he stops selling, when he gets out of his position, it's going to go back up, or that's why it's going down. That's information but that doesn't apply. I don't care about that because that's very short term. That's the information that traders get on the phone with each other, talking to each other, and sometimes they're playing each other, literally. Sometimes they're lying. Well, I'm going to unload that, and oh, he's going to unload that. Then I better unload mine. Meantime, this guy's now going to unload his because he thinks I'm going to unload 40 million shares. What am I doing when he's unloading? I'm buying it. So those are the games that are played on Wall Street at that level. And believe me, I played those games, and they're fun. But for individual investors starting out, you don't need connections. It's got nothing to do with connections. It's got to do with what you want to do, what you think. You're going to be right most of the time if your thinking is clear. That's it. Just trust yourself. New investors have to trust themselves because I know something. Invest in something that you know about. Oh, fashion. If it's a woman. I had a great story I was in the green room of Fox a couple of years back, and this PA says to me, Shah, I don't know how to start. I'm so scared of this. So how do you do it? And I said, well, I love what you're wearing. She goes, oh, that's such and such, and it's Coach or whatever it was. And this, and I said, oh, that. I said, so you know a lot about fashion? Oh, yeah. I said, start there. What do you mean? I said, go look at Coach stock. She came back the next week. I bought some Coach stock. And then a couple of weeks later, I saw her. She goes, oh my gosh, I'm up like 20% in 3 weeks. I'm like, there you go. I said, by the way, if you think the Coach is going to, then somebody else is going to do better, and Coach, maybe their designs aren't going to be good, they're going to have a bad year, so that you know that because you wear the stuff. Maybe it's time to take a profit at some point. Oh, okay. So invest in what you know, what you understand, and if you don't understand it, then invest in the narrative itself. AI, perfect example. AI is changing the world already, and we're never going backwards. AI is going to be everything in the future. Companies that rely on AI are going to be able to turn AI into revenue and profits. Go there. It's easy to understand. So how do you do that? I'd take a look at, say, Microsoft. Okay, oh my gosh, all the information they have, all the data they have, all the stuff they have, plus they have the cloud, where all this data is going to be stored, where they can pull all this information and feed it into these AI models to get this and to get that and create the products and put it through their ecosystem. And we're going to have it in Outlook, and you're going to have it in all of their apps and so forth. Apple, same thing. If they're going to have it on the smartphone, it's going to be, oh my gosh, everyone's going to want that. There you go. Simple narrative. Who's going to be able to actualize AI and turn it into profits? Buy Apple, buy Microsoft. Pretty simple.
A lot of investors, at least especially for me, I started off, I guess, on YouTube as a quote unquote dividend investor, and I still love dividends. Who doesn't love to receive, passive income, if you will? But, I often always share it's important to marry your dividend stocks with growth opportunities. And I want to get your opinion on this because I often feel we so many times define ourselves and then stick exactly to whatever we define ourselves by. So if you're an ETF investor, you're just ETFs. If you're a growth investor, just growth. Dividend investor, you're only going for dividends. How important is it to actually really diversify your portfolio and dabble in growth stocks as well as dividend stocks, ETFs? How do we actually put together a winning portfolio?
There's a difference between diversification and what I say is that there's always an opportunity to make money somewhere. That doesn't mean you take every opportunity, because I'm not a fan of diversification, because I think too many investors over diversify, and you're going to just benchmark yourself. So if you think that you need safety, there's safety in owning 20, 30, 40 stocks, then you basically are going to end up just moving with the market, and that's fine. But if you're going to do that, then don't own 20, 30, 40 stocks. Buy an ETF that tracks the S&P. Buy SPY or maybe QQQ, which I think is better because that's where the tech stocks are in the NASDAQ 100. So that's the QQQ ETF. Buy that. You only have one stock to watch. You don't have 30, 40 stocks to watch. So if you want to diversify so much where you're just benchmarking yourself, then buy a benchmark. It's easier to watch. I think for me, optimally 7, 10 stocks is about right, because those are high conviction positions that I put on. And it's you can't watch 30, 40 stocks and you can't be successful because one of them is going to be up 50% this year, and then the others are going to be, all over the place. Well, if you just owned that one, if you had enough conviction to buy that one stock, you'd be up 50%. But now you've diluted that by you're up maybe 11%, which is not bad. But you could be up 11% if you bought the Qs or if you bought the SPY, because those benchmarks are up about 11% this year. So you make life a lot easier for yourself by doing that. Diversification isn't all that's cracked up to be. Investors need to have high conviction positions. Buy the things that you really believe and understand are going to go up and know why they're going to go up. Because if they don't, then you're going to know why they didn't. And they're like, maybe something happened that you didn't see coming, or the market's weighing on them. If the market's weighing on them, but you're right, and the market weighs on them and brings them down, I buy more. Like, I know I'm right. By the way, I'm not worried about certain positions, being right the next week, month, 6 months. I know in 2 years, that stock's going to double or triple. That's how I invest for a longer term. So it's not about diversification. It's about finding opportunities. And those opportunities, as we started out saying, maybe you think, oh my gosh, oil is going to go through the roof. Well, you don't need to buy oil futures. You can buy an ETF that tracks oil, right? So we have all of these opportunities now to invest in the things that we believe in are going to go up. Make life simple. You can invest in pretty much anything now through an ETF. And I love that. That to me has leveled the playing field for everybody. So if you like commodities, you don't know how to invest in them, but you don't want to put futures market too complicated, and it is for most people, you now can buy corn or wheat in an ETF. So very easy to do. And invest in what you know, what you think you understand, and why you think it's going to go up. That's it. Most people think investing is complicated. And to your question earlier, they look to Wall Street to give them answers. Those guys are salesmen. They're not giving you the answers. They're giving you the answers that helps them make money. It's not really helping you. So everybody has to come to the table with their own thoughts and trust yourself. I can't impress upon anybody enough. Investing is easy. It's not hard.
I'm almost feeling like we're duping ourselves when we start to define ourselves, right? So by calling myself a dividend investor and therefore I only invest in dividend stocks, I lose out on opportunities. I want to get your take on this, especially for all the dividend investors who are out there. It might be a hot take, if you will, but are we duping ourselves just investing into dividend stocks?
That's a matter of risk tolerance and what you like. Let's just say, and this is pretty typical, at a certain age or a certain station in life, I don't want to take massive risk. I've taken massive risk my whole life because that's my business. That's what I do, and I'm very comfortable with. But at a certain point, and I'm there now, where I'm out doing things that I want to do. I don't want to take a lot of risk to make a lot of money. So yes, I am more inclined towards having positions that I'm very comfortable with that aren't going to be that volatile, and that includes dividend yielding stocks. But I think starting out, if you're just looking for, say, a dividend paying stock that's maybe giving you 5%, 6%, 7%, that's great. And that compounds beautifully. But if your principal isn't growing and you're just collecting, let's just say your portfolio gives you 7%, your total portfolio gives you all 7% a year, but you're not getting any capital appreciation on your principal positions, then your 7% is not bad. There's nothing wrong with that. But if you had the right mix of 5, 6, 7 high conviction positions, you could be up 50%. I shoot for 25% a year. And some years I beat that handily. You're not going to get 25% return on your money with just dividends. So I look at it that way. I want my principal to be working for me. And if stocks throw off dividends, great. I take that dividends and I reinvest them back into the stock, because it's really about the capital appreciation that I'm after. The dividend is just more juice to throw back into that stock, and then that grows. So I'm like, great, then I get more dividends and I put more back into there. That's really where the way I look at dividends is they're incremental capital positions that you need to put to work.
What do you think about, you say, the younger investors going strictly into dividend stocks? And the reason I ask is because, again, I'll even out myself here. I started off as an ETF investor, moved into all the dividend stocks, enjoyed I want to say it was a lot of YouTube hype, right? It was passive income every month and the dividend income. But then I said to myself, wait a second, it's this whole thing. I mean, if I'm investing for the next 30, 40, 50 years, it's about total return here.
Great point. It is. Again, what I was saying a minute ago is at a certain age, there's nothing wrong with going off to do what you want to do, and your money is making a nice return for you because you got a nice pile of it. If you don't have a nice pile of it, you're not going to get a bigger pile by just collecting dividends. So it's about appreciation. It's about the stocks going up. It's about your trades turning into investments that become, that make you wealthy. I'm a big fan of dividends for people who don't like a lot of risk and just want to collect that income. That's great. Perfect. But if you're young, you got another 10 years, 20, 30 years of investing ahead of you. Dividends are nice. They're not good. They're just, that's tip money, really. You're not going to get rich off the dividends. You will get rich off of owning the right stocks.
I want to ask you this question, and you already alluded to it. Having a smaller portfolio is important. Again, outing myself, in 2020, I mean, I bought a lot of stocks because all the discounts and deals that were out there. And then I realized I spread myself so thin, and there's no way I can absolutely look at all of these companies and understand their story. But moreover, I heard this Bill Ackman interview where he was asked about the size of a portfolio. He said, look, at any given time, there's really only about a handful of high quality opportunities out there in the market. And so if you're investing in 20, 30, 40 stocks and you're missing out on the real quality gems, what would you define as a high quality stock opportunity out there?
First and foremost for me, and I think for your audience, it's really, again, about the narrative. What is the narrative about this company? What does it do? How does it do it? How do they make money? What's their addressable market? And how are they going to grow? Oh, pretty easy to understand something like Apple when you look at it through that prism. It's like, oh, okay, I understand what they do, what they sell, smartphones, tablets, this, that. Oh my gosh, they have all this other stuff going on too. They have the most popular smartphone in the world, and they're going to be applying AI throughout their ecosystem. We're going to have on our smartphones, we're going to have such a massive amount of AI on our smartphones, and Apple's probably going to lead that's the narrative. You understand that, and that's why you invest in that. You don't need to go deeper. You don't need to find maybe Ackman's high conviction positions are different than mine, but I will bet that mine are going to do as well, if not better, just because I understand those narratives that I'm applying my money in, and as he does. And he's not always right. No, he's taken some brutal beatings on stuff that I watched some of this stuff. And I'm like, wow, why would he do that? And so, I don't care how big you are, you're not always right. And so again, following someone like that, you end up buying something that he's buying and it goes down. You're like, no, did you understand? Or are you just following him blindly because you think he is a great guru and he's always going to be right? No, he's not. Buffett the same way. People follow Buffett as if has a small, he has a concentrated portfolio. People don't realize. They think, oh, he hates diversification. He says diversification's for idiots. So these are high conviction positions he has. But the luxury he has is he owns giant chunks of companies. Why does he do it? Why did it take him so long to buy Apple? He didn't get the technology. He said, I don't understand the tech. I'm old. I have cabinets and I write everything. I don't even have, when he started to understand it, then he invested. He made a fortune on it. Now he's sold a good chunk of his position. It's about conviction, about understanding what you're investing in and not over diversifying. So Ackman is a very smart investor, needless to say, but nobody's perfect. George Soros is another very smart investor, multi-billionaire. Icon is one of my favorite investors. These guys, they do make mistakes, but they all have concentrated positions. None of those big guys, or Stan Druckenmiller, none of those guys, the guys that I respect because they have been so successful with small, high conviction positions. These are multi billionaires. That's how they do it. That's how everyone should do it. Don't over diversify. You're not gonna, and don't follow anybody. If you listen to Ackman and you like his ideas, or he's talking about a particular stock, do you like it? Don't buy it because you think he likes it. He's buying it. Do you like it? Do you agree? Do you understand the narrative of what he's saying about why that's a good company, why it's going to go up? It's up to you. It's your money.
I want to ask you, if you were to have the opportunity to grab a beer or a dinner with someone in the investment world, and now obviously, again, you've been on Wall Street, a hedge fund manager yourself. I'm curious to know who you'd actually go grab that beer or dinner with, and what exactly the conversation would be, or what would be some questions that you would ask perhaps your investment icon.
Well, I've never been asked that before. I have to think about that. It wouldn't be Warren Buffett because I understand how he thinks, and I read enough about him, and I've followed him in terms of what his positions are and what he does. So I understand how he invests, and I'm somewhat of a disciple of Graham and Dodd, and I understand his investing mantra and how he looks at companies. So I wouldn't choose Warren. Probably I would say probably Stan Druckenmiller, because I trade the way he trades, and Druckenmiller famously, was working for Soros, a hedge fund, when they put on the trade that basically broke the Bank of England, and they were the first traders to make $1 billion on a trade, and that goes way back. He invests that way, high conviction, and when there's nothing to do, he doesn't do anything. If he doesn't like what this, it's not an opportunity. He doesn't see an opportunity. He doesn't just go look for them and make stuff up. He's like, well, I need to put my money. He waits. And when he sees what he wants to see, like, oh, this I think is going to happen, then he goes all in with a huge position. And I would probably like to pick his brain. It's like, wait, what creates your conviction? No, I know what creates mine. I'd like to pick his brain and say, well, when you lever yourself up into a position, and this position, what gives you that conviction? That would be interesting to hear from someone like Stan Druckenmiller.
Some people would say that in that time, that in between time, you just have this cash pile, this reserve cash pile. You're almost wasting time and not investing, and therefore you should dollar cost average in. But then you get some of these big players that don't do that. What's your take on dollar cost averaging? Should the smaller Joe be doing that?
If you got a pile of cash and you want to invest it, it shouldn't really be in cash. It's the only time you should be in cash is if you're getting a really good yield, say on a money market. Okay, then you can put your money in cash. But if the market, and that's if the market is flat, the market's going down, you're not sure, you don't have any high conviction investments to put the capital into, then yes, that's fine, but you should be making some yield on that. Or you think the market's going down, or the market is going down, and maybe you get stopped out of some of your positions. That's fine. If you get stopped out with the profits, great. Now you got that cash. What are you going to do with it? Let it sit on the sidelines until you're ready to invest it. But when you are ready, invest it. If you don't know what to do, and like, okay, now you're convinced, you've got strong conviction that the market is bottomed and it's going to start going up, and you haven't done your work yet, like you're not sure what narrative you're leaning into, or you're just working, what am I going to, I have all this cash, I park it in the queues, because while I'm looking for those high conviction trades, I want to be in the market, but I want to be in the NASDAQ 100. I want to be where the tech stocks are, because those are the growth companies. Still, these giant mega caps are still growing like small growth companies. The stocks are doubling, tripling. Look at NVIDIA, for example. Microsoft. These are gigantic companies whose stocks keep going. Microsoft's going to double in another 2 years, maybe quadruple in 10 years. Apple, same thing. These companies are going to continue to grow and continue to make money. There's no limit on the size. And for investors with money, if you like the market, you're comfortable that the market is going to go up, then park it in an index fund till you create your portfolio of your high conviction positions. Why? Because you're in the market. And if you're not sure what to do, but you're pretty sure the market's going up, you'll turn around and go, holy mackerel, it's 6 months. And the Qs or the S&P is up 20%. I'm up 20%. It's better than the 5, 4, 3% you're going to get in money market funds as rates come down. Your money on the sidelines isn't going to be working for you the way it did a year ago. So I used to park my money when I had capital that I was waiting to apply. I used to, years ago, I parked it in Ford. Why? Because Ford had a fantastic dividend, to speak to your dividend play. So I look at my idle cash and I want it to work for me. So I will put it into a high dividend yielding stock. And back then, Ford was paying a huge dividend. It was like, this is great. Ford stock wasn't doing anything, so I wasn't really going to make money on it, but I was collecting a fat dividend on my idle capital. That for me is where I'm going to put my capital when I'm not sure yet where I'm going to invest it, in a high yielding stock that I don't think is going to go down. I don't, if it goes down a little bit, I don't care, because it'll eventually go back up, but I'm getting a really nice yield. I prefer it go up or do nothing, and then I'm still getting a nice return on it. So the problem investors have, the folks that have money that are not invested, that's the problem. Start. You don't have to put all your money into the market. Start with a small piece. See how that, put on a position. If it goes your way, you're going to say, oh, this isn't that hard. Then take another piece of that capital and go find another high conviction position and put some money into that. Before you know it, you've got a handful of positions, and they're probably all going to be working for you, especially if it's a bull market and you have the right stocks and you understand the narrative, and other investors are looking at that narrative, those narratives, and like, yeah, that's going up. I see that. Then they're going to help. They're going to create the momentum that you already knew was going to happen. And before you know it, you're like, this isn't hard.
This
It's
begs
easy to
the
make
question,
money.
and it's almost a perfect segue. What is exactly the biggest mistake you think investors continue to make?
I think there are two. Number one, and it's the worst mistake, is hanging on to positions that are going against them. And that's fear. And that's, oh, it's going to come back. It's going to, I can't afford to lose that, but I am. I'm just going to stick with it. And it goes down more. And then, of course, the fear just intensifies, and you are the deer in the headlights, and you don't know what to do. So you do nothing. That's because you didn't have a plan. That's what folks who start out doing end up never getting back in the market. It's like, no, that's too complicated. I lost money. You lost money on a trade, one position, whatever it is. You should have gotten out. So traders need to have an understanding of, okay, if this goes against me for whatever reason, what can I tolerate? Maybe I can tolerate 10%, 15%. Why? It's not all your money. It's one position. So let's just say I'm going to put a random number out there. You've got $100,000 or $10,000. You take a tenth of that, take $1,000, if you've got $10,000 to invest, and you put it on that position. So if it goes against you, like, I don't want to lose too much. Maybe it's 10, 15%. You get out. You reassess that stock. Like, what happened? You have to understand. This is the mistake that investors make. Understand why it went down. Maybe you were right, but maybe your timing was off. Maybe the market all of a sudden slid and it took your stock down with it. If you see that, then it's like, then don't worry. It's like, you know what? Maybe just leave it. This is a really great company. But if you believe it's a great company and you have a little more capital, maybe you want to buy more when it's down. If you need that money, then have a stop in place, get out with 10, 15% loss, and revisit it, because you don't want to freak out. But don't stay with a stock that is a high flyer, you think it's somebody recommended, and you don't really know it and understand it. This is the biggest mistake. Well, Joe told me that this stock is going to go up 100% in a week, so I bought a chunk of it. And it goes down. You don't know why, and you lose money, and then you stick with it. That's death. And that'll ruin you from doing anything else. That's the biggest mistake investors make. And they just cut your losses. The other mistake they make is sometimes taking profits too soon. If it's a trade, it's a trade. You have a time horizon. You have an expectation of what it's going to do. So you buy a stock for whatever reason, the earnings are coming up. You think the earnings are going to do well. This or that's happening. You might want to, it's a trade. Then take your profits. You're up 25%, 50%. You have an expectation that I'm going to take my profits, take your profits. The mistake investors make is if that's a really good company, don't take your profits. Let them run. Let them run. Because in 2 years, 4 years, 5 years, you'll have quadrupled your money. It's like, wow, I could have made 50%, but then you look at it 4 years later, well, I'm up 250%. So I think investors sometimes take profits too soon. If the market is going your way, the stock is going your way, let it go. Let it run.
Yeah, I'm just gonna out myself here, and I shared this a couple weeks back. I did this with Apple, and Apple hit a peak of, I think it was like, $196 per share, and that was just the day before that Tim Cook came out to announce Apple AI, and I said, let me just take a profit here, and I'll move some capital elsewhere. And to this day, I'm still kicking myself from selling a few shares there of Apple. Is there an appropriate time to actually trim those profits?
I think so. Am I a buy and hold guy? Certain positions, yes. It doesn't mean that I don't take profits, but here's the trick. If I think the market is going to turn, and using Apple as an example, Microsoft, some of the big positions I have, I'd want to get out of the way. Even though I know long-term, those are great companies, I want to hold them. I'm a trader. That's first and foremost what I am. So I've got a ton of profits in there. I'm going to find a level where I'm going to take those profits. The thing that investors don't do is have a plan to get back in. Okay, so you take your profits, and if I'm right, and the market comes down, and Apple, Microsoft, those positions come down, and I've got my cash because I sold, and I've got a ton of profits in there, I'm absolutely looking for a re-entry point because I want to own them. But now, if I'm right and the market's going to hit them, down 10, 15, 20%, thank you, I'm going to go back in. A rule of thumb I have is if it's a bull market, and I get stopped out of a position, maybe I put the stop in a little too close to where it's trading, is coming back down, and I get stopped out. If the market is still up and going up, and I know we're in a bull market, for example, I'll give it maybe 5%, maybe 10 if I'm not sure, higher than where I got out. So yes, I got out. Stock is, I got out maybe at the wrong point, but I've got my cash. Now the stock goes back up. Well, it's because the market's going back up. Oh, darn it. I shouldn't have gotten out, but I did get back in. I like buying stocks that are going up. It's not like if you miss that and you don't get back up, say 5% higher, it's like, so what? You left 5% on the table. So what? You're back in the stock, and then it goes up and up and up. But if you don't get back in, you're like, oh my gosh, this stock is up 100% in a year from now. You're like, what? I call it my 5% rule. 5% higher than where I got out. If I like it again, I'm going to get back in. I don't worry that I should have stayed in. I shouldn't have gotten out. No, I don't. It's a trade. Get back in. That's a big mistake investors make, is if they take profits on something, it's a great company, you want to get back in. So what if you get back in higher? You got to be back in that stock because it's going to continue to do what it's done before. You were right before, you're going to be right again.
I feel like everybody's got a sob story with NVIDIA with that exact storyline. Like, I wanted to get in here, I got out, and I wanted to get back in. The stock kept climbing, and I never got back in.
Well, that's a great point. I never worry about stocks that I missed. Never. It's that old adage. There's always another. To me, the market's like a bus stop. There's always another bus coming along. You can get on it. Don't worry if you miss so what? It just goes. It went. Oh, it didn't get into that. So what? Oh, it would have been nice to own NVIDIA way down at $50, but I didn't. So do I worry about that? No, I don't care. I buy it higher. So what? I don't care. You should never worry about what you missed. Never. You're going to miss a lot of stuff. You have a 7, 10 stock portfolio and you didn't own that one. and that's up 200% because whatever happened. So what? You're doing just fine with what you're doing. You're not going to you're not going to find every stock that's going to go through the roof, period. And if you go chasing them all like that, you're going to spread yourself a little too thin and you're not going to make money.
Shah, are there any trends right now that you're taking a look at that you think a lot of investors are overlooking?
I think oil is, I like oil down here. There's some beaten up stocks like Intel down here that I really like down here. I think it's cheap. It's a longer term hold because the company hasn't been doing well. And I think they've got a bunch of problems they got to figure out and fix, but they will, but it's on sale. So I like stocks like that. I like, again, oil down here. You can buy USO, ETF. I think, but investors are, I think, everyone who's looking at AI is trying to get the big picture. And part of the big picture that they're not getting is what's going to power AI? It's power, electricity. And we're not going to be all electric. We need oil to drive, a lot of electric plants and natural gas. Those investments now are starting to look cheap. Oil is down, nat gas is down. I think those are really great opportunities for the long run. I think you can make a good money on that. Again, that's go where the opportunity is. They're on sale right now. Oil and nat gas are cheap right now, and it's something that I would put on as a trade because they're commodities. I don't hold commodities forever. I trade them. So if I can buy oil at 70, low 70s a barrel, and I can sell it at 110, it's a nice trade over 6 months, a year. It's a great trade. But because commodities are cyclical, it may come back down. I'm going to take my profit. I'm just not going to leave it there. And then next, 2 years later, it's at 40. It's like, oh, wow, I had a huge profit. And now I'm underwater. No, it's a commodity. Commodities trade on cycles. You have to understand what you're investing in. And is it a cyclical type play, then trade it that way.
I've had a few investors come on now who they've come off of Wall Street and they define themselves as traders, active traders, constantly watching the market. And then I've had a lot of investors on here that are just, again, that buy and hold type. And we know it all comes down to risk tolerance. But what's interesting to me is the guys who come off of Wall Street are still very active in trading. Is there something that us average Joes are missing about the trading game?
No, no. That's a career path. And I was on that path. And that's what I did. Believe me, I make more money now not trading the way I did. I have high conviction positions and I do trade, but I don't watch the market every day. I know where it's going. I know what it's doing, but I'm never glued to my trading screens ever. I'm only glued when I'm putting on a position or something is happening and I want to look at see where if I would need to do anything. Those are, generally speaking, few and far between times. Just think that folks who think that they can make a career out of sitting trading all day, good luck with that. Not a lot of people are cut out for that. I mean, to do that all the time is really hard. Years ago, I had, when I was running my hedge fund, I also had a trading room because that became popular. Everybody was doing day trading. And so I opened up a beautiful trading room with top of the line, everything, market data access and screens. And it was just beautiful. And the people that came in, they thought, okay, I'm not selling insurance anymore. I'm not going to do real estate anymore. I quit my job. I'm going to make, none of them lasted. None of them. A lot of people came through that job. It's trading like that. Not many people are cut out for it. So I don't recommend that. I think people who are just glued to their screens trying to make money, they're not going to be successful. They're going to get lucky and they're going to be good for a while, but then they're going to have their downtimes. Then if you lose your capital, it's like you're out of the game. I think that's a mistake. I would never recommend that kind of trading to anybody. People all the time ask me, well, you did it. And I said, yeah, but that's what I did. I didn't plan on doing that. I ended up doing that. And believe me, I did it very well, very successfully, but not without its toll. I mean, it's there's a the high price to pay for that kind of trading. And it's 24/7 stress. So I'm happy not to be doing that. And I'm making more money. So don't trade. Don't overtrade. Doesn't mean I don't put on positions, for example, that are trades. And by that, I mean, usually they're options positions. And in terms of the options positions, I'll put on spreads. I won't necessarily, if I think something's going up, I want to play something going up, and I think it's going to go up very quickly over a very short period of time, I'll buy a call spread on it. If I think something's going down, I'll buy put spreads on it. So those are trades, but I don't sit and watch them. I put them on. I was like, yeah, if I'm right, I just made, 100% on that trade, 200% on that trade. Oh, I lost 50% on that trade. I'm out. That's trading for me. But I'm not sitting here watching them. I put the positions on. I go off and do what I do.
Shah, your best investment to date, what was it? How did it go down? What's the story behind it?
Microsoft. I was in the Fox studio, Fox Business News. I'm doing Stuart Varney's show, Varney Company, and this is 2009, I think. And so Stuart, I'm with him in the studio, and before we're about to go on air, he says, I own Microsoft. What do you think of Microsoft? And I think it was probably trading like 28 around, and then some $28 around there. It's most of my retirement is in, what do you think? I said, I love Microsoft. He said, should I take some of my profits? It's up nicely. I'm like, no, it's going to double. It's going to double. He said, Sean, that's a big company. I said, oh, it's going to double. And it's going to double again. It's going to double again. He said, how is a company that size going to double? It did. It did. And it did. So something like that is why? Because I'm talking to you on a Surface machine. I use all of everything from Outlook to all of their stuff, everything Microsoft. I love the fact that they have the cloud. And I just knew that once Steve Ballmer got out of the way, I didn't know Nadella was going to be so fantastic. I just knew that Ballmer was holding the company back. And I thought the reason was he had so much skin in the game. He didn't want to lose. He didn't want to try different things because he didn't want to be wrong. So I was so glad he got out of the way. Ballmer was gone. Now he's got more money than anybody. And Nadella came in. He had no skin in the game. He had to earn it. So what did he do? He took the company directions he thought he would make the most money for himself, for the company, for shareholders, and love the guy. That's why the stock did that. So understanding what the company did, understanding the management, understanding specifically the Ballmer was holding the company back, and that a new guy, and in Nadella, I liked him. I didn't know he was going to be the genius that he is. I just said, okay, hopefully this is the guy. And I put more money into Microsoft, and I'm very happy that I did. So I'd say that, but that was always understanding what Microsoft did, using the products, liking the products. I do have a couple of Apple computers also, but I just prefer Microsoft products, and I've always leaned into them. So that was just understanding that, and then understanding Nadella's push into the cloud. Like, wow, that's brilliant. That's where everything's going. So it's understanding the narrative, understand what he was doing with the company. And as big as it is, it doubled and tripled and quadrupled. And it's going to continue to do that because it's a well-run company.
The fascinating point about insider activity, and I think Steve Ballmer still holds, if I'm not mistaken, I think he still holds vast majority of the shares there. I think the biggest shareholder, I think.
I don't know if he or I think Gates is probably bigger, but I don't think Ballmer has sold much, and smartly because
you knew
obviously the company is now well run and the stock has exploded. So yeah, good for him.
It's interesting though to think about that skin in the game and how it could actually be very restrictive for a company. Usually you think, oh, the more a CEO or an executive has in the game, the more they're going to try to do whatever they can to get the stock to get driven back up. Question for you about now what just happened with Starbucks getting their new CEO. Talk about a new insider coming into the inside team with Brian Nicole. Any upside potential there, you think?
Yeah, I think Starbucks is a great model. It's done really well. It's time. It was time for a management change, and I hope he does a great job. I mean, he's got a great history, great track record. So, I think it's probably a good value right now. Is it for me? It wouldn't be a high conviction position. It's something if you like Starbucks and you want to invest in it, I say, yeah, I think now's a good time. But to me, it's not going to have the growth trajectory that a tech stock would have. When you have limited capital, we all have limited capital. It's about where you're going to apply that capital. Yes, that might be a great position, but I'm going to find out where my capital is going to work best for me. And I don't think it's going to be for me in Starbucks. I think I can find better companies that have a better growth trajectory. McDonald's is another good one. Great company, but it's not a tech stock. If you own it, good for you. But if you're starting out, I wouldn't buy Starbucks. I wouldn't buy McDonald's. I want something that's going to grow. I want to grow my money. So tech is really where it is and where it's going to be. Those other companies are going to do well. They're going to, if you have a broad portfolio and you like them and you want to over diversify, great, pick great stocks. But again, you're going to benchmark yourself because the other ones that are going to really excel that you may own also, they're going to wish you just owned more of those and less of those.
My last question for you, Shah. It's my favorite question to ask all investors. I have a hunch. I know where you'll take this answer. But if I were to throw you $10,000 right now and have you select just one stock to invest it into, what stock would it be and why?
Wow. One stock.
One stock.
Because I'm a bit of a contrarian at times, and that more often than not works out well, I would go with Intel. It's a long-term hold. It's going to be volatile, but I think in 4 years you will probably quadruple your money. They're going to get their act together. They have to, and when they do, that stock is so undervalued that I'm going to put on a big position in Intel. I've already started to acquire some, but that's a long-term hold. I will not sell that. So if I double my money, quadruple my money, I will still be pleased. Keep going, because I think it's going to go because that's the business of technology, of AI. It's chips, right? This is the only one that's on sale. This is the only chip company that's on sale right now. So you got to buy that.
Shah, you shared a lot of insights about Wall Street, the market, investing, stocks. If we want to find more insights from you, where do we go? Is there a newsletter? Is there somewhere we can just find all of Shah's insights to get inside your mind?
Yeah, and it's free. TotalWealthResearch.com. There's a ton of content on there. I 3 times a week, I'm doing videos on there. I'm doing takeaways for what's happened and what's likely to happen. And I'm writing about where the market is, where it's going, and about sectors, and giving my readers stock advice. I like this. Here's why. I don't like that. Here's what we're doing in one of my paid for services. We're actually shorting that. I don't like that. So people are going to get a lot out of it. Total Wealth Research. It's free. It's a great landing spot because there's a lot of content there, and it's all timely. It's all about the market. It's all about how to make money.
Investors, you heard it here first. Go down to the pinned comment. You're going to find some links to get into the more wisdom of Shah Gilani's stock insights. Shah, I want to thank you for joining me on Masters of the Market. And most importantly, investors, until next time, we will see you all there.